In late March, early April 2018, you don't have to look very far to find a long list of bearish signals. How concerned should we be? As we do every week in these videos, the commentary that follows relates to our approach and our time frames. And the reason why we're saying time frames plural is the CCM market model is a multiple time frame model. Understanding your time frames and the relevance of information, or the lack thereof, is of uppermost importance in the financial markets. This week's video is being recorded after the close on Thursday, March 29, 2018, and Friday is a market holiday, and therefore we are in the midst of a holiday weekend, and thus we are going to move quickly. S&P 500 daily, 1995 to the year 2000. We know in environments that are marked by strong secular trends, our goal is to navigate between a point A and a point B that could be several years down the road. And in this case, the gain between point A and point B was very satisfying. It was an order of magnitude of 232% in the S&P 500. And as always, we'll tie this discussion into the present day or late March of 2018. This is an article that appeared on a major financial website on March 23, 2018. NASDAQ breaches a key trend line for first time in 6 weeks in a bearish sign. The NASDAQ composite fell firmly below its 100-day moving average. A break below that level is viewed as a bearish sign. Now, there's been all types of articles floating around that are very, very similar. Some of them look at the 100-day moving average. Some of them reference something as short as the 20-day moving average, and some of them key in on the 200-day moving average. And if you're a client and you've read something like this, you might have wondered, how concerned should we be when an index drops below its 100-day moving average? Said another way, when the S&P 500 dropped below its 100-day moving average, between point A and point B, would that have been particularly helpful in terms of helping us navigate between point A and point B and or capturing a reasonable amount of the 232% gain? So in order to answer the larger question, let's examine this question. How many times did the S&P 500 price in green drop below the 100-day moving average between point A and point B? The answer is an eye-popping 79 times. Therefore, let's assume, for conversation's sake, that my signal was that I buy when the S&P 500 crosses above its 100-day moving average, and I sell when it drops below. Using that simple approach, I would have executed 158 trades between point A and point B. And relative to our approach, and our time frames, multiple time frames, including very long time frames, it would be very, very difficult to say that a signal that occurred 79 times between point A and point B, especially when we consider the gain between point A and point B was 232%, that signal was particularly helpful. In fact, we can make an argument that that signal could have been harmful or incredibly distracting relative to keeping our eye on the prize, which is trying to navigate between a point A and a point B that could be several years down the road. Another logical question. How many trading days between point A and point B ended with a close, S&P 500 close, below its 100-day moving average? The answer? 197 trading days closed below the 100-day moving average, telling us that either a drop below the 100-day moving average or a close below the 100-day moving average doesn't necessarily give us a lot of good information about a long-term secular trend, and more importantly, the sustainability of that trend. So let's throw the 100-day moving average on the graph so we can see it. The S&P 500 price is shown in green, the simple 100-day moving average in red. Are we trying to insinuate that a drop below the 100-day moving average is irrelevant? Not at all. So if we circle back, for our purposes and under our approach, how concerned should we be when an index drops below its 100-day moving average? The answer is it depends. Context matters. Not all moves below a 100-day moving average are created equal. There's nothing particularly magical about a 100-day moving average, a 20-day moving average, a 200-day moving average, or any moving average that we can pick on any time frame. If you've done extensive back testing, you know that you can test the 100-day moving average and the performance of the 100-day moving average between a point A and a point B could be extremely poor. And then you test the 105-day moving average between the same point A and point B, and it can be dramatically different. A weight of the evidence approach takes that into account. We understand before we get started that there's no such thing as a perfect input to any model. There's no perfect time frame. There's no perfect moving average. There's no perfect form of a moving average. There are some advantages to using simple moving averages and some advantages to using exponential or faster moving averages. The same can be said for any risk-on, risk-off ratio or an indicator. For our purposes, a move below the 100-day moving average, the significance of it has to be weighed within the context of the weight of the evidence. And that's exactly how we do it and how the model does it. Therefore, under our approach, when we see a headline like this, it can be unnerving. In fact, an article like this, or a tweet like this, or a post that has something like this can exacerbate many of these common missteps. It can cause us to watch the markets too closely. It can get us focused on some type of bearish forecast. When we read this, we might have a tendency to worry about what everyone else is doing, or worry about what everyone else is saying. When we see things like a bearish sign, we may be more apt to try to avoid volatility. It creates fear about a pullback or a bear market. And in short, many articles and commentary that include technical analysis have a tendency to have us think in short-term time frames. Here's another anecdotal example, Investors Business Daily, which is a fine publication. There's a lot of good information in Investors Business Daily. Article says, breach of 50-day moving average is a key sell signal. How helpful would the 50-day moving average have been in this case? This is the S&P 500, calendar year 1997 and all of 1998. Between point A and point B, the S&P 500 gained 66%. So let's assume that we simplified. We often hear simple is better. Let's assume our approach was we buy when the S&P 500 moves above its 50-day and we sell when it drops below. Would the 50-day moving average have helped us navigate between point A and point B, or helped us capture a satisfying portion of the 66% gain that was available? Or would it have created an incredible amount of confusion, and would it have generated an incredible amount of whipsaws and frustration? The S&P 500 moved above and below the 50-day moving average, which is shown in red, countless times between point A and point B. Think of this period here if that was your signal. I buy when it moves above, I sell when it drops below. You would have been out of your mind right here. You would have been pulling your hair out. Similar situation here, and a shorter term whipsaw city here as well. Which brings us to an important point about building systems and models. We 100% support the concept that simple is better relative to complex. And our own experience in the markets over the years bears that out. All things being equal, simple is better than complex. However, Albert Einstein can help us put a little finer point on the conversation. Everything should be made as simple as possible, but not simpler. Same concepts here, so we'll move a little bit faster this time. S&P 500, 2003 to the peak in 2007. if our goal is to navigate between a point A and a point B that could be several years down the road. In this example, and in the real world, how concerned should we be when an index, a stock, or an ETF drops below its 200-day moving average? Were drops below the 200-day moving average helpful between point A and point B? And more specifically, how many times did the S&P 500 drop below its 200-day moving average between point A and point B, which featured a 77% gain? The answer is 81 times. So we have 81 times where the S&P 500 drops below. That's spread out over roughly a 1, 2, 3, 4, 5-year period. 81 divided by 5 comes out to be 16.2. So 16 times a year that happens. And if I'm using that as an entry and exit signal, for the most part, it's 32 trades per year. But more importantly, once again, something that happened 81 times during a 77% A to B move over 5 years, we really have to ask ourselves, if it happened 81 times, what does dropping below the 200-day really tell us about the vulnerability of the long-term trend? Looking at the same period, how many trading days between point A and point B ended with a close below the 200-day moving average? A whopping 186 days. Once again, a close below a 200-day moving average does not seem that abnormal within the context of a bullish trend. If it happened 186 times during a 77% move, we have to question in isolation, how helpful is that information? So once again, for our purposes and under our approach, how concerned should we be when an index, a stock, or an ETF drops below its 200-day moving average? The answer is it depends. Context matters. Not all moves below a 200-day moving average are created equal. To use a simple analogy, if I told you I was driving 80 miles per hour, your gut might be that that sounds dangerous. But let's think about how dangerous that is. If I were driving 80 miles per hour on a secondary road in a school zone at 3 p.m. on a weekday versus driving 80 miles per hour on a multiple lane Autobahn in Germany. Driving 80 miles per hour on the Autobahn is not particularly dangerous, especially in light traffic. So like many things in life, in the realm of technical analysis, context, or the weight of the evidence, it matters. This is the trading range that we covered in last week's video. In fact, this is the chart we used dated March 23rd. If we overlay a weekly chart a week later, so this is now March 29th, we can see during the week, we stayed inside of the trading range. We really didn't get anywhere near 2532 this week. And the S&P 500 was able to tack on 52 points during the holiday shortened week. You can also make an argument here that this is a doji type indecision look where the battle between the bulls and the bears was actually quite even relative to the weekly high and the weekly low. And sometimes a doji is an indecisive look that tells us we could be open to a reversal. As noted on Twitter this week, we also had the first DeMark aggressive sequential 9-13 setup, and that's a potentially bullish setup, a reversal setup. It's the first time one of those signals has been printed since the retest of the low in 2016. And if you know your market history, this was an outstanding entry point. We've discussed the trading range because it's a reference point. For clients, it should also be noted the trading range has absolutely positively nothing to do with the market model, and a break of the trading range in isolation wouldn't impact our approach in any way, shape, or form. However, we understand how math works. If price gets down into this area here, it's going to start to have an impact at some point on the facts that we have in hand. And as we noted last week, if the market wants to move into this area, which is always a possibility, and it stays below 2532 for any length of time, at some point, the answer to this question, are we allocated properly based on the facts in hand, will be no, and we'll make an incremental adjustment as needed. When we asked that question over the last 4 days, the answer was yes, and therefore we did not take any action. Notice in this flow chart here, it says that we have to continually repeat that process with a flexible and open mind, and that will be true as we head into next week as well. We're open to all outcomes. We're simply assessing probabilities, the probability of good things happening long-term relative to the probability of bad things happening long-term based on the facts that we had in hand on March 23rd. And we did the same thing on Thursday, March 29th, because that was the last trading day of the week. The flexible, unbiased, and open mind does not speak to our assessment of the probabilities. We can confidently assess probabilities using facts. What we have to keep an open mind about is what next week could potentially look like. The data could improve next week, it could drift sideways, or it could get significantly worse. Continue to take it day by day. Before we review some other charts relative to the health of the market, we're still inside of the trading range. This is March 23rd. The S&P gained 50 points. Last week, we said the big picture still looked good from a probability perspective. So as you might imagine, we most likely would draw the same conclusions this week. But let's look at the hard data and let's not assume anything. These are some weekly moving averages that are used by the CCM market model. In this instance, the model is asking a very, very simple question. Is blue above red? Is blue above green? And is blue above pink? It's a binary yes or no answer. This is the full bore, all affirmatives, and this is the full bore, all negative responses. How do the exact same moving averages look today? When the market opens on Monday, it will be 65 calendar days since the market peaked in late January of 2018. So in this segment of the video, we're comparing the period roughly mid-November to mid-December. This blue box. How does this blue box compare to this blue box? You'll notice 65 days after the market peaked in 2007, all three of the binary questions asked by the model were coming back with a bearish response. 65 days after the peak in 2018, all three questions are coming back with a bullish response. How long will that be the case? We have absolutely positively no idea. But we can confidently look at this chart on Thursday, March 29th and say blue is clearly above red, blue is clearly above green, and blue is clearly above pink, telling us that the market's trend is much, much stronger 65 days after the peak in 2018 than it was 65 days after the peak in October, November 2007. And after we could see this, measure it, and put it in a model, really bad things happened. Similar situation, weekly moving averages. Now we're looking at tech, the triple Qs in the ETF world, relative to defensive gold. 65 days after the market peaked, the answer to all three binary questions, a no, and a no. 65 days after the market peaked, if we look at the same ratio in 2018, we get a yes, a yes, a yes. Similar situation here, 65 days after the market peaks, the ratio of stocks relative to bonds, or risk on, risk off, we get a no, and a no. And in the present day, 65 days after the stock market peaked, we get a yes, and a yes. A reasonable question might be, in the present day, is it really helpful to consider stocks versus bonds as a risk-on, risk-off ratio? You can make the argument that in the present day, bonds are extremely risky. But we have to ask ourselves, why is that the case? Why do some people view bonds as being extremely risky in March of 2018? It's because the economy is strong, the economy is growing, the general consensus or the net aggregate opinion in the market is not forecasting an economic collapse or an imminent recession, nor is the Fed. In fact, many Fed members have come out recently and said the risk to their economic forecast is to the upside. When the economy is strong, the Fed is raising rates. That is a period that is unfavorable to own bonds. But the scenario that we just described, why bonds can be perceived as risky in the present day, that scenario doesn't align with a bear market or recession story at all. So the fact that people are making arguments that bonds are risky here tells us something about the strength of the economy and the current direction of interest rates. When the market starts getting fearful of an economic contraction, typically inflation will start to wane and the Fed will start thinking about lowering interest rates instead of raising them, and bonds once again would become attractive. There's a reason bonds are perceived as risky today, and it speaks to a strong economy. How about our 100-day all the way out to the 290-day simple moving average? Any big changes there? Does the present day look like this or this? March 16th, the answer was no. March 23rd, a week ago, after the S&P 500 got hammered last Friday and dropped 55 points, the answer was still no, that this looked like a sustainable bullish trend that would eventually go on to make higher highs and really didn't look anything like this. If we fast forward a week, we have a very, very similar look. Not much has changed, telling us that the trends were very, very strong prior to the start of this correction. And it's very, very difficult to make an argument that this chart here, with blue creeping into the moving averages on several occasions, some of the slopes rolling over, and getting a tight cluster here all the way back in late 1999, this really doesn't look anything like this. And yes, it is possible that the present day could morph into something like this. And if that happens, eventually when we ask the question based on the facts in hand, are we allocated properly? Instead of coming back with an affirmative or a yes, we will get a no. And we would begin to make incremental allocation adjustments to get ourselves back in line so we can once again answer the question, yes. It would be helpful if we link back to these examples one more time and ask one more question in each case. We know the S&P 500 dropped below its 100-day moving average 79 times between point A and point B. What percentage of the 79 drops below the 100-day moving average were eventually followed by higher highs and higher profits for patient investors? Let's ask the same question about the 81 times below the 200-day between this point A and this point B. What percentage of the 81 drops below the 200-day moving average were eventually followed by higher highs and higher profits for patient investors? This is the long-term breakout chart in the NASDAQ that we covered a week ago on March 23rd. Given the NASDAQ gained 1% over the past week, we know that this breakout is still holding. We've talked about demographics numerous times in these videos. There's an article, Market Watch, March 27th, that ties into that theme. Research says that millennials are saving money, but they are understandably reluctant to invest in the stock market. Having an extremely large group, an important group of investors that are skeptical about the markets does not sound like a period that's going to mark the beginning of the end for a bull market. From the Wall Street Journal this week, the fact that so many people think the bull market is about to end tells me it's going to keep going for a while yet. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.